Digital transformation in banking is mostly a myth, and the numbers prove it. 51% say they're going digital, but only 7% are actually getting the results they intended. If your strategy is all talk with no foundation, your bank won't survive the next 5 years. So what causes this disconnect? Why is there such a performance gap between ambitions and what's actually being deployed? In a word, it's leadership. When I speak internationally and I'm asked what stands in the way of success in digital transformation, it's usually not technology, budget, or even the use of data. It's the ability for leadership to embrace change, take risks, and disrupt the status quo. I'm Jim Marous, and we continue to dig into the 2025 Retail Banking Trends and Priorities Report sponsored by Q2. For this report, we analyzed data from hundreds of banking executives worldwide. What we discovered reveals some striking disconnects between what banks say they're doing and what they're actually accomplishing. Today, I'm going to share 5 critical insights that will determine which institutions will thrive in 2025, next year, and beyond, and which ones will definitely be left behind. Be sure to download the full 2025 Retail Banking Trends and Priorities Report. The link is in the description below. Let's start with the biggest paradox in banking today. Banks are spending millions on digital customer experiences while their core infrastructure is literally crumbling beneath them. Here's the data that should keep CEOs awake at night. 52% of institutions prioritize improving customer experiences, but only 25% are modernizing their legacy system. It's like renovating your kitchen while ignoring the fact that the foundation is sinking and the plumbing is leaking. Why are banks putting the cart before the horse? It's simple. They're chasing customer expectations without building the infrastructure to support them. When your competitors are fintech companies and big tech firms that can launch new features in weeks, not months, you feel pressure to rush digital rollouts. But here's what happens when you build beautiful front ends on a broken behind-the-scene back end. 22% of institutions admit that they have unclear transformation goals because they're constantly firefighting system failures. Here's the hidden cost that nobody talks about. When you try to integrate new digital capabilities on a 30-year-old or older core system, your project timelines are increased by 40%. I've seen banks and credit unions spend 2 years building a rather simple digital account opening process only to have it fail in the final step because their core systems couldn't handle the data formatting that was necessary. But here's where it gets interesting. Credit unions are actually taking a completely different approach. 46% of organizations, credit union organizations, in our survey are prioritizing legacy system updates first. As Mark Seavright told me recently, it's not inertia, it's investment capability and capacity. Credit unions can't afford to fail, so they're building the right foundation first. The institutions that survive the next 5 years and beyond will be those that resist the temptation of flashy customer-facing features and instead build unbreakable technological foundations. Now let's talk a little bit about AI and why most banks are completely missing the point, at least in my perception. Current AI adoption looks like this. 33% use it for fraud protection, 30% for process automation, and 28% for basic chatbots. But here's the shocking statistic. Only 13% are using AI to build personalized customer recommendations. Now think about that. Netflix knows your entertainment preferences better than your bank knows your financial needs. And Netflix doesn't hold your life savings. Why are banks playing it so safe? There's 3 reasons. First, the risk-averse culture of banking prioritizes operational safety over customer innovation. There's nothing wrong with that in context. However, when it's completely ignoring customer innovation because they're afraid of the risk, that's where it gets bad. Secondly, there's regulatory uncertainty around AI making financial recommendations, talking about privacy and personal data. We can work around and work with current regulatory foundations. And third, we have plenty of security experts, but lack customer experience AI talent. Here's the untapped potential. Our research shows that 80% of institutions expect AI to drive personalized marketing by 2030. That's a massive gap between the current state of affairs and future expectations. Meanwhile, 66% of customers are already comfortable with their financial institution using AI to personalize their experiences. We need to catch up. Let's give you some real-world examples of what's possible. Instead of simple balance notifications, AI could send proactive spending alerts based on unusual patterns. Instead of generic investment advice, AI could make recommendations based on your life stage, risk tolerance, and actual financial goals. For small businesses, AI could predict cash flow problems and automatically adjust credit lines before problems occur. The banks that win will use AI to handle efficiency-driven tasks while empowering their human advisors to handle higher value, personalized guidance. The losers will keep using AI to replace humans instead of augmenting them. Let's dive into payments for a minute, where competitive gaps are becoming wider and wider. Here's a stat that should alarm every credit union executive. 62% of banks that we research now offer real-time payments, but only 40% of credit unions do. That's a 22% percentage point gap in the capability that customers increasingly expect as table stakes. But why are credit unions lagging? As Mark Seavright explained to me, the fraud issue around real-time payments is palatable. It's in every conversation I have with credit unions. Real-time payments mean real-time fraud risk with no reversal capability. Smaller institutions simply don't have the fraud detection infrastructure to compete safely. But here's what's reshaping everything. Apple Pay, Google Pay, and other platforms are setting the standards for payment experiences. Our crystal ball projections that we included as part of this year's report show that 70% of executives believe that more than half of payment transactions will occur through non-bank channels by 2030. Another 48% believe that plastic cards will account for less than 25% of payments during that same period. The brutal reality is if banks don't innovate their payment interfaces, they risk becoming invisible pipes in the customer purchase journey. Big tech is already providing the customer experiences, and banks right now are just processing the transactions behind the scenes. The institutions that will thrive will implement comprehensive real-time payments capabilities with AI-powered fraud protections. Those that don't will find themselves increasingly competing on price alone in an increasingly commoditized marketplace. Now, for the most counterintuitive finding in our entire report, branches aren't dying, they're evolving, and in many cases, expanding. 33% of financial institutions plan to expand their branch networks in 2025. For credit unions, the number jumps to 61%. Meanwhile, only 8% are planning network reductions, down from 13% last year. Wait, what? In an era of digital transformation, why are institutions investing more in physical locations? Well, for one thing, digital transformation really just isn't killing branches. Complex financial decisions still require human guidance. When you're building your first home, starting a business, or planning for retirement, you want to look somebody straight in the eye. Digital channels are fantastic for existing customers managing routine transactions, but branches can convert prospects into customers much more effectively. But the new role of branches is completely changing. Branches are becoming relationship centers and not transaction processors. They're hosting community events, offering financial education workshops, and providing co-working spaces for small businesses. The most innovative institutions are integrating technology in these spaces and shrinking the spaces significantly, using digital tools to support human conversations, not replace them. Here's the strategic insight. Credit unions understand something that many banks are missing. Local market presence builds trust, and trust builds business development. They're not expanding branches to process more check deposits. They're expanding to deepen customer relationships. The winning strategy isn't always digital versus physical. It's creating seamless experiences that let customers engage on their own terms. Finally, let's talk about the partnership revolution that's reshaping the competitive advantage. 64% of institutions that we surveyed already partner with fintech firms, with another 17% planning to do so this year. But here's deeper insight. 86% rely on external providers for technology improvements. The era of building everything in-house is officially over. Why is it no longer viable to go it alone? Technology development cycles are now measured in weeks or months, not years. Customer expectations are set by tech giants and fintech innovators. Internal development costs are 3 to 5 times higher than partnership solutions. And frankly, you can't hire enough developers for every capability you have to put in place. Instead of being locked into your core provider's limitations, you can now mix and match the best-of-breed solutions. 38% of institutions that we interviewed prioritize third-party providers specifically for speed and innovation. Digital account opening leads that partnership priority at 49%, followed by financial wellness solutions at 41%. Instead of spending 2 years and millions of dollars building a financial wellness platform, you can now partner with an established provider and deploy their solutions across your entire database in months. You can absorb the R&D investment while they absorb your regulatory compliance burden, and customers get capabilities faster. So win-win capability. The institutions that master this composable approach will run circles around those still trying to build everything internally. So what does this all mean for you as a banking leader? Here are 5 critical actions you must take to succeed in 2025 and beyond. First, foundation before flash. Stop chasing the next shiny digital feature until you've modernized your core systems. Credit unions have this right. Build unbreakable infrastructure first. Second, shift your AI strategy from operational efficiency and fraud protection alone to customer value creation. Use AI to understand and serve customers better, not just to cut costs. Third, implement a comprehensive real-time payments capability with robust fraud protection. Don't let Apple and Google and others own the payment experience while you process transactions in the background. Fourth, reimagine your branches as relationship centers, not transaction processors. Continue to shrink your physical presence. Even though it still matters for trust and complex financial guidance, you don't need them in a case where you're just trying to build more and bigger customer relationships. You can do that digitally. Fifth, develop a comprehensive partnership strategy. The institutions that win will be the master orchestrators of ecosystem capabilities, not the builders of everything. The bottom line is that success in 2025 requires balancing technology innovation with human relationship building while maintaining the trust that forms banking's foundation. The question isn't whether to transform, it's whether that you build the right foundation for sustainable innovation. The banking industry is at a critical inflection point. The business is moving faster than ever before, and it will never move this slowly again. The institutions that make these strategic shifts now will thrive in the years ahead. Those that don't will find themselves falling woefully behind in an increasingly commoditized marketplace. Be sure to download the full 2025 Retail Banking Trends and Priorities Report. The link is in the description below. Also, watch my keynote address I did in Abu Dhabi where I share additional trends, and download the podcast where I interviewed other Q2 executives about the 2025 Retail Banking Trends and Priorities Report.